Let's be honest, nobody enjoys giving away their hard-earned money, especially not to the government. We work hard, we budget, we smash the like button for the algorithm. We try to save every dollar we can. When tax season rolls around, it can feel like a mandatory penalty for being productive. But here's the thing. It doesn't have to be that way. Getting a big tax refund isn't about getting free money. It's about reclaiming the money that was yours to begin with. It's a refund of your overpayments. Thinking about it this way completely changes the game. It's not a lottery win, it's a correction in your favor. Maximizing that refund is one of the smartest financial moves you can make each year. That extra cash could be the difference between paying off a high-interest credit card, finally starting an investment portfolio, building up your emergency fund so you're prepared for anything. It could be the down payment on a duplex you plan to house hack. Every single dollar you get back is a dollar you can put to work for you, rather than letting it disappear into the giant pool of government spending. It's about being strategic and taking control of your financial destiny, one tax form at a time. It's your money, and you should fight to keep as much of it as legally possible. Alright, let's break this down to its absolute simplest form. Imagine your income for the year is a big pizza. Before the government takes its slice, they let you take a few small pieces off the top for certain expenses you had. These pieces you take off are your deductions. If you earned $60,000 but you had $5,000 in deductions, the government now only looks at the remaining $55,000 when calculating how much tax you owe. You're not getting a dollar-for-dollar discount on your tax bill, you're reducing the amount of your income that is subject to tax in the first place. It's a simple but incredibly powerful concept. Every dollar you can deduct is a dollar that gets taxed at a 0% rate. A lower taxable income means a lower tax bill. It's that straightforward. The government creates these deductions to encourage certain behaviors. Saving for retirement, going to school, running a small business from your home. They are essentially rewarding you for doing things they see as beneficial for the economy or society. Your job is to identify which of these rewards you qualify for and claim them. It's not cheating the system, it's using the rulebook they wrote. This is where people leave so much money on the table. It's in the small, forgotten expenses that add up to a huge number by the end of the year. Let's start with one that has become incredibly common, the home office deduction. If you are self-employed, a freelancer, a gig worker, and use a part of your home exclusively and regularly for your business, you can deduct a portion of your housing expenses, rent or mortgage interest, utilities, internet bill, homeowner's insurance. So many people work from home now but completely forget to claim this powerful deduction. Next up, let's talk about student loan interest. If you paid interest on a student loan during the year, you can likely deduct the amount you paid, up to $2,500. This is an above-the-line deduction. You don't need to itemize to claim it. The bank will send you Form 1098-E showing how much interest you paid. It's basically free money back for an expense you had to pay anyway. Don't throw that form away, it's literally worth cash. Another huge one people miss is contributions to a traditional IRA health savings account, HSA. When you put money into a traditional IRA, that contribution can often be deducted from your income, lowering your tax bill this year. It's a double win. HSA goes in tax-free HSA, grows tax-free HSA, withdraw tax-free for qualified medical expenses. If you have an HSA and aren't maxing it out, you're missing out on one of the best tax shelters available. Finally, don't forget about charitable contributions and specific work-related expenses if you're self-employed. Okay, so how do you actually find and use these deductions without getting a headache? It's simpler than you think. The first step is to get organized throughout the year, not just in a panic a week before the tax deadline. Create a system. This could be a simple spreadsheet, a dedicated folder in your email, even just a shoebox. I personally like using a spreadsheet. Create columns for the date, the vendor, the amount, and the category of the expense, like home office, business supplies, charitable donation. This turns a mountain of receipts into clean, usable data. Step 2 is to actively review your bank and credit card statements every single month. Don't wait until the end of the year to try and remember what a specific $75 charge from Amazon was for. Go through your statements and categorize your spending as it happens. Was that purchase for personal use or was it for your business? If it was a business expense, log it immediately in your spreadsheet or digital folder. This proactive approach takes maybe 30 minutes a month but will save you hours of stress and potentially hundreds, if not thousands, of dollars later on. You will be shocked at how many deductible expenses you find. Let's make this crystal clear with some real-world examples. Meet Sarah, a freelance graphic designer who works from her apartment. Her apartment is 800 square feet. Her dedicated home office is a 100 square foot spare room. That means her office is 12.5% of her home's total area. Her annual rent is $24,000, and her utility bills for the year total $2,400. Sarah can deduct 12.5% of these costs. That's $3,000 for rent and $300 for utilities, giving her a $3,300 home office deduction. She also spent $500 on a new office chair and $1,200 on design software subscriptions. That's another $1,700. In total, she just reduced her taxable income by $5,000. Now let's consider Ben, a recent college graduate working his first job. He's paying back his student loans and managed to pay $2,200 in student loan interest this year. He receives Form 1098E in the mail. Because this is an above-the-line deduction, Ben can subtract that full $2,200 from his gross income, even if he takes the standard deduction. If Ben is in the 22% tax bracket, this deduction alone saves him nearly $500 on his tax bill. 2,200 times 0.22. It's a simple, direct saving that required nothing more than entering a number from a form he received in the mail. If there's one golden rule in the world of taxes, it's this. If you don't have a record of it, it didn't happen. You can't just tell the IRS you spent $1,000 on business supplies and expect them to take your word for it. You need proof. This is why keeping meticulous records is not just a good idea, it is absolutely essential. Receipts, invoices, bank statements, canceled checks. They are your evidence. They are your defense in the event of an audit and your key to unlocking every single deduction you are rightfully owed. Without records, your deductions are just wishful thinking. The fear of an audit is what stops many people from claiming legitimate deductions. But here's the secret. An audit is not scary if you are prepared. It's simply a request from the IRS to verify the numbers on your tax return. If you have a receipt for every deduction you claimed, an audit becomes a simple process of showing them your organized records. Meticulous record keeping gives you the confidence to claim everything you're entitled to without fear. As we've seen, boosting your tax refund isn't about some secret, complicated hack reserved for the financial elite. It's about paying attention. It's about being diligent and making small, smart choices throughout the year. The difference between an average refund and a fantastic one often comes down to tracking the small stuff. The journey to becoming tax savvy starts with a change in mindset. Stop viewing expenses as just money going out. Start asking, is this potentially deductible? This is the foundation of building wealth. Taking control of your taxes is financial empowerment. So start today. Every small step you take will lead to big savings.